It's my pleasure to introduce Greg Udell. Greg is the Chase Chair of Banking and Finance at the Kelley School of Business at Indiana University in Bloomington, Indiana. He has worked with the Board of Governors of the Federal Reserve System, the Bank of Japan, the European Central Bank, the Federal Reserve Banks of Chicago and San Francisco. You missed one in the middle of the country, Greg. The International Finance Corporation, the OECD, the People's Bank of China, the Reichsbank, and the World Bank. Wow. Do you sleep? Yeah, that's great. Prior to beginning his academic career, Greg was a commercial loan officer in Chicago. So please welcome Greg Udell.
Thanks very much, Julie. Thank you. I'm not going to formally introduce my colleagues on the panel, but there are bios in the package, and in the interest of preserving time, we'll just start right in. And the first paper is by Rebel Cole, so Rebel.
All right, my study is entitled, Did Bank Small Business Lending in the United States Recover After the Financial Crisis? I thank the Office of Advocacy of the U.S. Small Business Administration for funding this and some of my earlier research on this critically important topic. You can find these studies at their website. The Great Financial Crisis was primarily driven by losses in the banking sector of the economy. During the crisis years, regulators closed almost 500 banks, and another 500 banks disappeared in mergers. Research by Professors Reinhardt and Rogoff suggests that bank-driven recessions are much more severe and last longer than typical recessions driven by events in the economic sector, taking an average of 8 years for real per capita income to return to pre-crisis levels. In my 2012 SBA study, I documented how bank lending to small businesses plummeted during the financial crisis years of 2009, 2010, especially at the largest banks. Since the aggregate bank loan data reported by the FDIC indicates that small business lending continued to decline during the post-crisis years of 2011, 2013, but so did the number of banks, making it difficult to determine if banks have continued or loosened tight credit policies. Aggregate data for 2014 to 18 shows very little in the way of any recovery in bank lending to small businesses. Well, why is this important? Small businesses, according to the US SBA, account for 99% of all businesses, about half of private sector employment, and about 2/3 of net job growth. Both theory and empirical research indicate that capital-constrained firms grow more slowly, hire fewer workers, and make fewer productive investments than firms utilizing debt in their capital structure. A better understanding of how bank lending to small businesses fared during the post-crisis years provides policymakers and regulators with guidance regarding how to tailor legislation and regulations to boost bank small business lending to small firms, thereby increasing both employment and economic output. In this study, I analyzed data on both the amount and the number of both the stock and the flow of small business lending to provide new evidence on how bank lending to businesses, and especially to small businesses, changed after the financial crisis years. I also provided results from tests for difference in the lending behavior of large banks versus small banks and troubled banks versus healthy banks. I find that despite a recovery of overall business lending by U.S. banks after the crisis, small business lending remains depressed, particularly among large banks and among banks in worse financial condition. The academic literature on small business lending goes back 60 years. There are hundreds of studies by many of the people in this room and elsewhere I cannot do justice to. I've hoped that I've included most of those in most prominent in my bibliography, which is in the paper. So the data I'm going to look at come from a number of sources. First is the FFIEC report of condition and income. Second is the FFIC CRA data on small business loan originations, the FDIC Directory of Institutions, and the FDIC's quarterly banking profiles. My first primary source is the quarterly call reports filed by each commercial bank. They provide information on the number and amounts of outstanding loans to small businesses. So we can look at this as the stock of small business lending. My second primary source is the Community Reinvestment Act database on small business lending. CRA requires larger banks to report both the number and amount of small business loans originated by each bank in each year. As of 2016, there are about 700 banks filing. CRA does not cover the smaller banks, but it covers the majority of banking assets. This information can be viewed as the flow of small business lending. It's important in any study of small business lending to adjust for the effects of mergers. I'm sure my colleague to my left here is going to talk a lot more about that in her paper. But I do merger adjusted data, which is critical. I split the industry into large and small using a common threshold of $1 billion in 2000 inflation-adjusted dollars. I split the industry into healthy and unhealthy using an adjusted capital ratio of 4%, where I define capital as equity plus loan loss reserves minus NPLs minus REO, all divided by total assets. This I find stunning. This is the aggregate dollar amounts of big business and small business lending. Lending to big businesses recovered very quickly after the crisis. It fell just for a couple years. It's almost double the pre-crisis level. Not so for small business lending, which remains well below pre-crisis levels. In the next slide, I look at the average change in dollar amounts of small and total business lending by year and bank size. Small business lending is on the left, total business is on the right. The red is the small banks, the green is the large banks. And what you'll see is that the recovery has been much stronger for total business loans, especially at large banks. This is similar, but this is by year in bank health. And we see here there were large post-crisis declines in all types of business lending, both small and large, at troubled banks, which is not surprising. Next, we look at the average change in the number of loans outstanding by year and bank size. Again, small banks are in red, big banks are in green. From 2006 to 2009, the number of small business loans declined by much more at large banks than at small banks, but we also see a stronger rebound in the 2011 to 18 period. At troubled banks, in red on the right, the average percentage change in the number of small business loans was negative almost every year. In the next slides, I will turn from the call report data on outstanding loan amounts to CRA data on loan originations. The FFIEC is running a little bit late with the 2017 data, so the most recent data I can present is through 2016. This shows the aggregate and average amounts of small business loan originations to firms with revenues of less than $1 million. Aggregate amounts of originations are in green, average amounts are in red, in millions, aggregates in billions. As you see, there was a huge decline in originations from 2007 peak through 2010, followed by a meager rebound through 2016. This is similar data, but looking by bank size on the left and bank health on the right. Decline in originations was much greater at large banks and at troubled banks. There was little in the way of a rebound during the post-crisis period, except at small banks, which you see on red in the left. Now we'll move on to the average and total number of small business loan originations to firms with revenues of less than $1 million. Again, we see the same huge decline from 2007 to 2010. By 2016, the rebound was only back to 2005 levels. This is the average number of small business loan originations by bank size and bank health. Bank size on the left, bank health on the right. There was a much greater decline in the number of originations by large banks during the crisis, but also more of a rebound. At troubled banks, it's difficult to see much of a pattern. I also use a multivariate difference in difference regression methodology using panel data with bank and year fixed effects. I'll spare you the details which are available in the paper. In general, they conform to what we've seen in the previous charts. Bank size, did larger banks disproportionately reduce lending during the crisis? Yes. Did larger banks disproportionately increase lending after the financial crisis? No. By financial condition, did troubled banks disproportionately reduce lending during the crisis? Yes, they did. Did they disproportionately increase lending after the crisis? Surprisingly, they did, but that's probably because the worst of the troubled banks were closed. In the multivariate analysis, I employ a number of control variables. I control for the bank's capital ratio, asset quality, earnings, liquidity, pre-existing loan commitments, and then bank fixed effects and year fixed effects. First, I look at the multivariate evidence of small business loans outstanding. Small business lending is red, total business in green, and you can see a much larger decline in small business lending than for total business lending and a much weaker recovery. At large banks, there was a larger decline in relative to small banks in small business lending, but not in large business lending. In the healthy versus troubled banks, at troubled banks, a bigger decline in small, but not total business lending, and a much stronger recovery. This is the change in the number of small business loans outstanding. At large banks, there was a greater crisis era decline in small business lending than at small banks, but post-crisis, there was a stronger large bank lending rebound relative to small banks. At troubled banks, there was a slight decline in lending relative to healthy banks, but post-crisis, there was a strong rebound relative to healthy banks as the worst banks were closed. Next, we'll look at the multivariate evidence on small business loan originations. These are the year fixed effects from the panel regressions, and we see this is where the change in lending relative to 2007, which is the omitted year. You see a large decline in origination started in 2008, and there's no real recovery through 2014. In this slide, we see that large banks increased amounts of originations by more than small banks, both during and after the crisis, but only after we control for leverage in NPLs. In large banks, we see similar post-crisis results for the number of originations. Recoveries only when we control for leverage in NPLs. For troubled banks, there's simply not enough troubled banks that report CRA data to do a meaningful analysis. So, to summarize and conclude, both total business lending and small business lending contracted significantly during the financial crisis years. Total business lending has rebounded post-crisis, but this rebound has been driven by new loans to big businesses, not by small businesses. Post-crisis, small business lending grew much faster at small banks than at large banks, while total business lending grew much faster at large banks than at small banks. Throughout the sample period, small business lending at troubled banks averaged only 3% as compared with 15% at healthy banks. By 4 different measures, small business lending has yet to return to pre-crisis levels. This helps to explain the anemic post-crisis recovery in terms of both employment output, policies to more quickly close troubled banks, and to incentivize large banks, possibly through CRA, to make more small business loans would help to boost the economy. Thank you.